Hi, Assalamualaikum, and have a very good day. Today we will be presenting a analysis of corporate financial performance, a trend and comparative study of Gamuda Berhad and Masing Group Berhad.
So this is our team members. We have Faris, Diana, Shazwan, Aima, and Joshua.
So Gamuda Berhad is one Malaysia's leading companies in engineering, infrastructure, and also property development. It was established in 1976 and it listed on the main market in Bursa, Malaysia. So Gamuda is widely recognized for major infrastructure projects such as Klang Valley MRT, Smart Tunnel, and the Pan Borneo Highway. It also developed large-scale sustainable township such as Gamuda Garden and Gamuda Cove. So the company itself operates in several countries like Australia, Taiwan, Singapore, and the UK. So next is Masing Group Berhad. So Masing was established in 1965 and started as a plastic product manufacturer. It entered the property development sectors in 1994, and today it's well known for developing affordable and mid-range housing projects such as M Vertica and M Arisa. This development mainly target the M40 and B40 income groups in Malaysia. Apart from property, Masing also still maintain its roots in plastic manufacturing, serving industries like electronics, automotive, and automotive and healthcare. So its manufacturing aims at revenue diversification and resilience to the group. So this company were selected based on several reasons. Firstly, is both companies are listed on Bursa Malaysia, which ensure transparent and accessible financial data, which is ideal for performance analysis. And secondly, they are offer contrasting business models within same property sectors. Like Gamuda is focused on premium, large-scale development with a strong engineering base, while Maxim targets affordable housing with manufacturing diversification. And this allows for meaningful comparison of financial trends, risk profile, and strategic approach. So lastly, both companies are responding to ESG trends, which is environmental, social, and governance trends, which adds value and relevance to their financial and non-financial performance evaluation.
Presenting a liquidity ratio analysis comparing Masing Group Berhad and Gamuda Berhad from the year 2020 to 2024. The key ratio we are focusing on is the current ratio, which is calculated by dividing a company's current assets by its current liabilities. Starting with Masing Group Berhad, we can see that it has consistently maintained a strong current ratio, always above 2.0 across all 5 years. In 2020, the ratio was 3.40, indicating that the company had 3.4 ringgit in current assets for every 1 ringgit of current liabilities. Although the ratio gradually declined to 2.01 in 2024, it still reflects a healthy liquidity position. This trend shows that Masing has maintained a strong ability to meet its short-term obligations even though there's a slight reduction in the liquidity cushion over the years. Now looking at Gamuda Berhad, the situation is quite different. In 2020, the current ratio stood at 1.34, which improved to 2.07 in 2021. However, from 2022 onwards, we see a declining trend, dropping to 1.12 in 2024. Although Gamuda has stayed above the critical level of 1.0, indicating it can still meet its short-term liabilities. The downward trend shows a shrinking liquidity buffer year after year. Now turn to the quick ratio, a more stringent test of a company's short-term liquidity. This ratio excludes inventories and prepayments because they are less liquid compared to cash and receivable. Starting with Masing Group Berhad, in 2020, the quick ratio was 2.79, indicating strong liquidity using only its most liquid assets. Over the years, there is a gradual decline, reaching 1.73 in 2024. Despite the drop, the company consistently maintains a ratio well above 1.0, reflecting a solid ability to meet short-term obligations without relying on inventory sales. Now let's examine Gamuda Berhad in 2022. The ratio stood at 1.29, improving slightly in 2021 to 1.97. However, from 2022 onwards, we observe a steady decline, dropping to 1.06 in 2024. The quick ratio in 2023 and 2024 are just above 1.0, signaling that the company is approaching the minimum liquidity threshold and could struggle to cover its short-term liabilities without selling inventory or relying on external financings. Move on to the analysis of net working capital. Looking at Masing Group Berhad, in 2020, Masing reported a strong net working capital of 3.10 billion, although it dipped slightly to 3.01 billion in 2021. The position was still healthy. From 2022 onwards, we see a downward trend, falling to 2.14 billion in 2024. This steady decline suggests increasing short-term financial pressure, possibly due to rising liabilities or slower growth in current assets. Now let's examine Gamuda Berhad. In 2020, Gamuda's net working capital was 1.13 billion, significantly lower than Masing's. However, it's improved over the next 2 years, reaching a peak of 2.65 billion in 2022. From there, a decline began, with net working capital falling to 1.76 billion by 2024. This shows that Gamuda experienced mid-period improvement but was unable to sustain it over time.
So now I will continue with time interest earned (TIE) between Masing Group Berhad and Gamuda Berhad from the years of 2020 until to 2024. And what is TIE? Time interest earned is uh, to show how easily a company can pay its interest using its earning. It, if it show the higher, the better it's get. So for the Masing Group Berhad, gradually improved from 2020 to 2023. Slight drop into 2024, but still strong. This means steady performance and good debt control. And for the Gamuda Berhad, up and down over the years, big jump in 2023 but fell again in 2024. Reflects bigger investment and changing profit. And for the summary between the Masing Group Berhad and Gamuda Berhad, Masing Group Berhad show stable and growing uh, graph, but the Gamuda show more risky but with potential.
As we can see, both companies show a decreasing trend in the average collection periods from 2021, 2022, and 2024. They show an improvement in their efficiency of collecting receivable. Masing Group Berhad has a shorter average collection period than Gamuda. This means Masing is generally more efficient at converting its credit sales into cash compared to Gamuda. Gamuda average collection period show a strong improvement, and Masing maintain a lower collection period. However, we can see that Gamuda average collection period is positive, and this suggesting that Masing has a healthier short-term cash flow cycles from its sale. Meanwhile, Gamuda's significant reduction in average collection period from year 2022 until 2024 is a positive sign, showing that they had better management with their working capital despite their longer collection period cycles. In this ARTO, Masik and Gamuda show a positive trend where we can see that both companies had an increasing ARTO over 2022 to 2024 period. As we can see, Masing they maintained a higher ARTO ratio than Gamuda Berhad. Masing also convert their credit sales into cash more frequently throughout the year. And it is normal for company in the property development and construction sector, which is they have a lower accounts receivable due to a few reasons such as long project cycles, retention sums, and progress billings. In inventory turnover or ITO, we can see Masing and Gamuda indicates clear upward in the inventory turnover ratio from 2022 to 2024. Both companies are becoming more efficient at managing their inventory and converting it into sales. Gamuda Berhad has a higher inventory turnover ratio compared to Masing Group Berhad. Gamuda is more effective at moving their inventory through its systems and recognize the associated revenue. This analysis showed the effective strategies by both companies to optimize the working capital and monitoring project life cycles. In the fixed asset turnover, both companies shows improved trend in fixed asset turnover from 2022 to 2024. They become more efficient at utilizing their fixed asset to generate revenue. The dip year in 2021 for Gamuda due to pandemic impacts. The consistent upward trajectory for Masing show the recovery in the market and successful leveraging of existing or newly acquired fixed asset for increased sales. Gamuda high and increasing fixed asset turnover suggests strong utilizations of its capital-intensive asset and its positive signs of operational efficiency. Masing fixed asset turnover lower than Gamuda but still show improvement, indicating they are effectively generating sales. Both companies are demonstrating improved efficiency in leveraging their fixed asset to generate revenue. In total asset turnover, we can see for both companies are inherently low, which under a ratio below 1.0. This is typical and generally expected for companies in the sector. Gamuda total asset turnover showed initial dip in 2021, but then a strong and continuous increase reaching 0.53 times in 2024. Massive total asset turnover show consistent from year 2022 to year 2023. However, there was a slight decline in 2024 due to the slight decrease in revenue in 2024. It's made due to new land acquisitions or increased inventory built up that has not yet fully turned into revenue within the fiscal year.
So, for Masing Group Berhad consistently show a stronger percentage, reflecting greater efficiency in controlling its direct production expenses compared to earnings across most of the observed years. Although Gamuda Berhad performed notably well in 2022, its gross margin typically falls short of Masing Group Berhad, especially in 2020, 2023, and 2024, where the gap is significant. This implies that Masing Group Berhad more reliably preserve a large share of its revenue after accounting for the direct cost of its offering. The next type of profitability. So, examining the operating profit margins, Masing Group Berhad generally shows stable, modest results, fluctuating between 9% and 60% over the period. While Gamuda Berhad, however, exhibited more fluctuations while starting at a higher 15% in 2020 and dipping to 13% by 2023, it recorded a significant jump to 50% in 2024. This stark difference in 2024 suggests that Gamuda Berhad experienced a substantial improvement in its operational performance that year, significantly surpassing Masing Group Berhad profitability. Okay, for the next one is operating ratio. So, from 2020 to 2024, Masing Group Berhad and Gamuda Group Berhad demonstrate varied strengths. Masing Group Berhad generally maintain a more consistent gross profitability, indicating effective cost control directly linked to sales for most of the period. However, its overall operational spending, while relatively stable, did not consistently lead to the highest opening profit levels. In contrast, Gamuda Berhad experienced considerable swings in its gross profitability and operational cost management. Despite a period of strong opening profit in 2024, this was accompanied by a noticeable increase in its overall operating expenses as a proportion of revenue, suggesting a complex interplay between revenue generation and cost containment over the year. Net profit margins. Masing Group Berhad generally maintain a more modest yet steadily improving profitability, starting at 6% in 2020 and reaching 10% by 2024. In contrast, Gamuda Berhad demonstrates a more fluctuating pattern. After matching Masing at 6% in 2020, its net profit margin rose significantly to a peak of 20% in 2023, showcasing a strong financial year. However, Gamuda Berhad net profit margin then sharply declined back to 6% in 2024, matching its 2020 level. This indicates that while Gamuda Berhad had a periods of exceptionally high overall profitability, particularly in 2023, Masing Group Berhad showed more consistent, albeit lower bottom line performance over the entire 5-year span. So the ROE for Masing Group Berhad and Gamuda Berhad from 2024 showing how efficiently each company uses shareholder money to generate profit. Masing Group Berhad generally displayed lower ROE figures starting at 3% in 2020 and gradually increasing to 6% by 2024, indicating a steady but a more modest return for its shareholders. In contrast, Gamuda Berhad exhibited more dynamic performance. While starting higher at 5% in 2020, its ROE significantly to peak at 17% in 2023, reflecting a period of a very strong profitability relative to its equity. However, Gamuda Berhad ROE then declined to 8% in 2024. Overall, Gamuda Berhad has demonstrated a stronger ability to generate returns for its shareholder in most years, particularly in 2021, 2022, and especially in 2023, despite a drop in the latest year. The ROA, Masing Group Berhad, the ROA has remained consistently lower, starting at 1% in 2020 and fluctuating since slightly to 3% at 2024. This suggests a relatively stable but less intensive utilization of its asset to produce profit. In contrast, Gamuda Berhad demonstrates a more dynamic ROA, beginning higher at 2% in 2020 and steadily increasing to a peak of 8% in 2023, indicating a period of higher efficient asset utilization. However, Gamuda Berhad ROA then dropped back to 3% in 2024. Overall, Gamuda Berhad has generally shown a stronger ability to generate profit from its asset in most years, particularly standing out in 2022 and 2023, despite its decline in the latest years, while Masing Group Berhad asset efficiency has been more consistent.
As a conclusion, from years 2020 to 2024, Masing Group Berhad saw steady revenue growth from affordable housing. Expenses were well managed, but liquidity dropped slightly due to more active capital use. Overall, the outlook remains stable and growth focused. For Gamuda Berhad, it shows strong revenues and profit growth driven by global infrastructure projects. It maintained solid liquidity but took on more debt for long-term expansion. The company's futures projection remains strong and ambitious. So that is all. Last but not least, we hope this analysis has provided a beneficial insight into of some financial practices. Thank you for your time and attention, and have a good day.